Investing in the stock market has never been easier. There's been amazing developments over the past couple of decades that have made the stock market so accessible for so many people. I'm going to highlight the 4 major ways that you can get invested in the stock market. The first one is by visiting your bank branch. If you walk into a branch and talk to someone who works there, they will be more than happy to make recommendations for you about what kinds of mutual funds you can invest your money in. The second one is to get a financial advisor. Now, a financial advisor is someone who's going to make decisions for you, or at least offer suggestions for you to make the final decision. A financial advisor usually requires a certain amount of investable money before they will take you on as a client. The third way is by using a robo-advisor. Robo-advisors have become very popular in Canada over the past decade or so, and for very good reason. With a robo-advisor, you're investing online, and the robo-advisor uses a software program to make recommendations about what you should invest your money in based on a series of questions that they ask you. And lastly is a do-it-yourself approach. Do-it-yourself investing is also an online way of investing, where you open an account online and you make all of your own decisions about what to buy and what to sell. There are really 3 features of each of these ways of investing that you should be aware of. So the first one is the choice of investments that you're offered. So if you walk into a bank branch, there's a very good chance that when the person there recommends some investments for you, they're going to be mutual funds, and they will very likely be the bank's own mutual funds. So if you go to BMO, they're going to offer you BMO mutual funds. If you go to CIBC, they're probably going to offer you CIBC funds. With a financial advisor, they're going to have a much larger range or portfolio of mutual funds to offer to you. So they could sell you an RBC fund or a CIBC fund or a Fidelity or an AGF or any other fund company that offers mutual funds in Canada. A robo-advisor, when they suggest a portfolio for you, they're going to suggest a portfolio of exchange-traded funds. These funds can be offered by a variety of different investment companies, but you won't have the choice of which ones you want to include and which ones you want to exclude unless you want to do it yourself. And when you're a DIY investor, the world is open to you. You can invest in pretty much anything you want. The second thing to consider when deciding which channel you should use is the amount of advice you're going to get. When you walk into a bank branch, you are going to get a recommendation of what to invest in based on a series of questions that you will be asked in the form of a questionnaire. So you will be given guidance, but the level of advice probably ends right about there. You might get a little bit of advice about an RSP versus a TFSA, but it's probably going to be fairly high level. A financial advisor, on the other hand, will offer you a lot more advice. So not only will they make recommendations for you, but you have the option of saying, just please decide for me. And so it takes the onus off you to really make those decisions. And they will also probably be able to offer you a lot more advice just beyond that. A lot of financial advisors will have a team of people around them who can help you do things like retirement planning, estate planning, tax planning, all these other aspects of personal finance. A robo-advisor will give you not a whole lot of advice beyond, here's a portfolio of exchange-traded funds that you can invest in. But again, that recommendation takes the onus off you of having to do the research and figure out what it is you want to own. And then, of course, when you're a do-it-yourself investor, there is no advice being offered. You are on your own, you're making all your choices, your own choices, and making all your own decisions. And lastly, when we think about what channel to use, you need to think about how you're paying for the advice or service that you're receiving. So when you walk into a bank branch, you are not going to be charged anything for getting that advice from the branch. However, when you buy the mutual funds that they're offering you, you're going to pay for that advice indirectly through the management fees charged by the fund. So you are paying for that advice, you just don't see it. A financial advisor can be paid in a variety of ways. So they put you in a mutual fund and they are compensated from the fees that you're paying on the mutual fund. There are other ways for them to be compensated. Some of them might be paid a salary, some of them might charge you a percentage of your overall assets. So it's really important when you're dealing with a financial advisor to really understand how you're being charged and how much you're going to pay. With a robo-advisor, there is no flat fee cost or upfront cost for the advice, but you will pay management fees on the exchange traded funds that you invest in. And again, that is sort of an indirect way of paying for the help of a robo-advisor. And lastly, with do-it-yourself, the fees can be various. So you will pay a trading fee. So when you buy a stock or an exchange traded fund, most likely you're going to have to pay a trading commission for that. If you own an exchange traded fund or a mutual fund through your do-it-yourself account, there will also be management fees to pay on those funds, although generally those fees are going to be lower than the funds that you have bought through a financial advisor or through a bank branch. So those are a few things to think about when you are deciding how you should get your money invested in the market.